Winning a prime property in today's market requires velocity. In high-demand areas, a distressed property hits the MLS at breakfast, triggers a bidding war by lunch, and is under contract before you finish your workday. Relying on a traditional bank mortgage puts you at a massive operational disadvantage. While you are busy uploading 3 years of tax returns to a portal, a cash buyer has already closed the deal and started demolition. San Diego serves as a primary case study for this high-velocity environment. The coastal inventory is tight, and the competition for viable investment properties is fierce. This intensity is especially visible in older, working-class neighborhoods. These areas are a major target for rapid fix-and-flip renovations, making them magnets for aggressive cash offers. In this environment, the availability of capital matters more than the interest rate. Speed is your primary currency. Conventional banks offer the cheapest capital available, but it comes wrapped in a rigid regulatory framework. Before a traditional lender approves your mortgage, they dissect your financial life. They verify your W-2s, calculate your debt-to-income ratio, and send your file to committee. This chart shows the timeline of a standard real estate transaction. As you can see on the top track, mandatory document checks push a conventional closing window out to 30 or even 60 days. Now look at the bottom track. Private capital bypasses these hurdles. Hard money lenders can fund deals in as little as 7 to 14 days, skipping the document-heavy committee reviews. Hard money is not a last resort for bad borrowers. It is a calculated bridge tool built specifically to solve the liability of a 60-day bank delay. That speed is possible because of asset-based lending, a total shift in how a loan is approved. Traditional banks weigh your credit score and employment history. Hard money lenders weigh the property itself. They evaluate the after-repair value, the projected market value after renovations. Because the property carries the weight, self-employed buyers can access capital even without perfect tax returns. It also allows developers to secure funding for distressed, unlivable buildings that conventional banks legally refuse to touch due to safety and habitability regulations. This system has a strict caveat. If the property's MAF is thin and lacks immediate equity, the lender denies the loan. Your personal wealth won't save a bad deal. Asset-based lending shifts the risk calculation away from your personal life and onto the concrete math of the real estate. Acquiring capital with this level of speed and flexibility is expensive. While a conventional bank rate might sit at 7%, hard money interest rates range from 9 to 13%. You must also factor in origination points. Private lenders usually charge 1 to 3% of the loan amount just to initiate the loan. You pay this premium for the lender's private infrastructure. You are buying the ability to close a deal in days rather than months. These rates create heavy monthly carrying costs. You are responsible for these high payments every month you hold the property. Those payments act like a ticking clock. Every month your project is delayed, the interest eats into your final profit margin. High interest is the purchase price for speed. You are paying a premium to capture the asset before someone else does. Operating outside of federal banking regulations allows private lenders to offer highly custom loan structures. They can provide interest-only payments to keep initial costs down, or set up staged draw schedules that release construction funds as specific milestones are met. This lack of regulation also means the industry has varying standards of integrity. You have to vet lenders for hidden underwriting fees or aggressive prepayment penalties. This fee is charged if you pay off the loan early, punishing you for finishing a renovation ahead of schedule. Freedom from bank regulation means you assume total responsibility for vetting the lender's legitimacy. This graph shows when expensive capital makes mathematical sense. Your strategy must aggressively outpace the debt's cost. Fix and flip operators buy, renovate, and sell properties within 18 months. Their forced appreciation absorbs the loan costs quickly. Self-employed buyers building rental portfolios often use DSCR loans. A debt service coverage ratio loan qualifies a borrower based on the property's rental income rather than personal tax returns. This strong rental cash flow justifies the higher rates. But consider a novice investor looking at a move-in ready property to hold long-term. Paying 12% interest on a property that only appreciates at 4% a year will eventually bankrupt the investor. Hard money is a precision instrument for forced appreciation. It is never a long-term solution. Asset-based loans are a tool for transition, not a final destination. Before signing, every borrower must have a confirmed exit strategy. This means either a confirmed sale to a new buyer or a solid plan to refinance into a conventional mortgage. Utilize hard money only when you have calculated exactly how and when you are getting out.